like it. All right, then. Good morning, everybody. It's Wednesday, June 19th, which freaks me out because life is just moving too fast. We're good. We got a bunch of people here. We got a bunch of people who are looking for the recording later, and we will post it all on the YouTube channel, which is another project that Luke and I need to spend more time on when we're not trying to chase deals. As lots of you know, but not everybody knows, we are a team of 3 associates. Mr. Loeffler is out of Ontario, actually, and he's off on vacation with his kids. I'm at home. Luke is in Calgary, staying at a friend's house with some lovely, lovely taxidermy, of which I'm highly jealous. The biggest change is that our multifamily got bigger, which is that I didn't do anything. My wife had a baby just about a month ago. And probably inspired by my good friend Barry McGuire, I will never miss a chance to share pictures of my family. But before I actually jump into a slide, there's cold open for you. The goal for these chats is not so much to go through a whole bunch of like, here's what the trend is, here's where the price is. It's more to share with you guys the types of information we're looking at, the sources we go to day by day, and then to break, to look at some of the macro trends, and then to identify kind of deal by deal or idea by idea, different trends that seem to keep coming up in our life and in the deals we're looking at, things that do work and don't work. But always ensure that we give a lot of time in these conversations for a chance to chat. We will keep the presentation part of this recorded. We'll keep the Q&A not recorded. So as much as you're in a room with, 20, 30, 40, 50 people, you do have some level of, if not confidentiality, then discretion. So we're going to roll through that, and we will go through that. We've also had so many interesting questions with people signing up that we've planned out at least 3 different mini webinars like this to cover topics like AI in greater depth and discuss some of the tools that we go through every time. But Luke and I will talk about a little bit more about how we structure deals and how we plan to bring our listings to market and why we're trying to make everyone else's job easier. You live in Alberta, there's no way to avoid, or in Ontario, I guess is a significant topic, is migration. I'm not going to get into the Ontario numbers. I ran this graph in 2 different time scales. The number of people moving to Alberta is bananas. And the number of anecdotal stories I hear from people in Calgary who put up an ugly basement suite and have 38 people on the lawn and 100 emails in 3 days. A good realtor friend of mine, Elizabeth Schellenberger, put up a simple little house for sale in like their original house, 1,100 square foot bungalow in Mill Woods. They put it up in the mid 400 price point. They weren't trying to lowball it. They had 15 offers. They sold it for 38 grand over a list price to an Ontario investor who had never seen it. So things like this are starting to show up when we're looking at people not only looking for a more affordable place to live, looking for economic opportunity, looking for an affordable place to be. We're seeing tons of it. And when we first saw this graph spike, I was like, maybe this is an aberration. Maybe this is not going to be consistent. It sure seems pretty consistent. The only thing I think that's interesting that we'll break into a little bit is a lot of this is politically driven. This is I was going to say the federal government, but this is Justin Trudeau deciding they want lots and lots of migrants, which there are good economic reasons for it. There are good social reasons for it, but never forget that politics can change quickly. So I like components of this migration. I have questions about other components. So I'm not going to hide the things I like and I don't like. This is just the closer time scale. Like and I feel like we're now in the phase of benchmarking everything against COVID, which I hate. So we go back to 2020. It's just a lot of people, man. Like again, at no point in our history did we ever have more than 40,000 people a quarter moving to Alberta. And now we've had it several quarters in a row. It's a lot of people. It really is. Someone criticized Edmonton has a plan to grow from 1 million to a 2 million person city by 2050. And they're like, that's crazy. We're never going to do that. Oh, yes, we will. Yes, Edmonton will get there. The part that's interesting, and I need to play with stats, Ken, and maybe someone can help me with this, is that the relative levels of interprovincial and international migration, we are getting a lot more international migrants than interprovincial migrants, which I think is great because people are recognizing now that landing in Toronto, where they're having to spend another $200 million to house asylum seekers, like there is nowhere to put people. There just aren't enough spaces. Coming here makes more sense. There are more jobs, there are more supports. What I'm trying to wrap my head around is when people come to Canada, how long until they move and how is that movement tracked, right? If someone comes here from whatever West Asian country, lands in Toronto for a year and then comes to Alberta, how do they track that? How can we kind of like pull those numbers further apart? For the moment, I like seeing kind of a 50-50 balance between the international and interprovincial numbers, but either way, both groups of people, when they land here, are almost always going to rent for about 2 years. It'll be a little bit longer on the international side of things than the interprovincial side. But as a rental housing provider, I love these numbers. And the people coming through are not, especially the people who are coming straight to Alberta, are frequently not the stereotypical asylum seeker type guys. They tend to be people who are more like opportunity driven migrants. And even my personal experience is, I went fishing with a kid the other day and there were 4 guys who were wearing like Afghani dress. And we came over and chatted. And one of them has been here for 3 or 4 years, was an interpreter back during the War on Terror, moved here. And then as his friends immigrate from Afghanistan, they come to Alberta because they have a network here. And that's a huge support to them. One of the guys literally was here 4 months, had a huge scar on the side of his face. And I was like, you ran from people shooting at you. Like there's a story there. They were fascinated about Canadian fishing. All of them, I learned a ton about the program we have for new international migrants that way and the resources they get. They basically get funded for a year. They get their feet on the ground, get their papers, get their education changed, do some language training. All 4 of them, especially the 3 new guys, were just so interested in getting out there and doing stuff. And they all had applicable workplace experience with admin or logistics or building, or it was surprising how many skills they had once you got through the language barrier and how much they wanted to just get shit done, which warms my heart, which is, I think, a very Alberta way to look at things. I'm pausing, Luke. I don't want to go back to talk about the people who have commented thinking that we're about to go into a giant recession. We'll come back to that. I think the biggest economic reason we need all this in migration is because Western countries in general, North America in particular, Canada in super particular, is becoming per capita less productive. Now, GDP numbers are great. Last year's full year GDP numbers, the West is just crushing it. I do have a slide in a minute about projections. I'm very happy with where the province is going. I think we have some energy issues with the federal government that I'm going to stay away from that political football for the moment. But even without that, the number of companies that we consistently run into that are involved in other parts of the economy, whether it be resource-based into forestry and mining, or into logistics or into technology, continues to surprise me. And the friends I have who do industrial, the amount of industrial development which is driven by owner users into manufacturing, into logistics is gigantic. So even if we did try to choke off all the energy related everything real quick, I'm very confident that the rest of Alberta will move in a great way. My favorite little thing is that de Havilland Aircraft Manufacturing opened a plant or is in the middle of opening a plant outside of Calgary. And they figured out Alberta. They figured Calgary out anyways, because they bought a tarp for a chuck wagon at the Calgary Stampede. And seeing that just warmed my heart, right? You're not going to advertise like that unless you're really trying to grow into a community and make an impact. So I have a forecast for all the different banks and where they think bond rates and the overnight rate's going to go. The only consistent thing about economists is that they're all wrong. But I like to think here they're wrong in the right direction. I can't imagine doing an economic forecast for PEI because it's just too dang small. But the West, I think, is going to continue to lead. Luke pointed out as we were preparing this slide deck, no one's beating inflation, right? I mean, this is real GDP, but inflation is a huge issue, and I've spent a ton of time learning about it, and I have an amazing resource we pulled up that's in a slide or two. But for the moment, I'm not concerned about where economic growth is going to happen here and where I'm seeing wage growth. As a guy who's trying to develop and build new real estate, I am concerned about wage growth, because when we have to pay the framers more, it starts to erode profits. But real GDP growth leads to people able to pay more money, which leads to people able to pay more rent, which leads to people able to pay more for housing, and it helps support the values of our assets. I have a couple of resources we pull inflation numbers from. The basic news outlets are not bad. And I mean, this is CBC. It's a helpful, if slightly confusing graph. But I think it's becoming, I love seeing these types of articles out in the public sphere, because I think that the level of financial literacy that most people endure is incredibly low. You know, I'm teaching my kids how to open a business. They start to understand how different costs change. You know, I'm not unduly concerned about mortgage interest, but the level of inflation for a lot of other things, particularly on this one, the sustained higher inflation rate on food will seriously affect our tenants. Most of my tenants are what I would call upper lower class, or the bottom bits of middle class when they're renting a townhouse or a duplex or a single family home. Those types of items will affect them. The money the government gave out the other day for grocery subsidies does not impact my tenants. They make too much money. We have a headline kind of inflation thing. I follow lots of different news sources. The most extraordinary resource I found comes from this gentleman who runs a consulting company, Paul Jacobson. His Substack is excellent. He has a slide deck with 141 slides just like this. This is all the components of inflation pulled out in exhaustive detail with some really amazing charts. I don't have a point from this other than this is the level of detail when I'm trying to figure out what's the impact of mortgage rates provincially, or the cost of fuel. I mean, we have cheaper gas here, and we've handled taxes on fuel very differently. We look at shelter very differently. This is the level of nerdy detail I like to read when I have time. I think that inflation, a lot of headline inflation, a lot of the part, I mean that in newspaper terms, a lot of the inflation numbers that we see, I don't think are going to change that much as we start to crank the overnight rate. I think until we start to see, there's a lot of people who are not impacted by, you know, the one lever the Bank of Canada gets, which is the overnight rate, at least until some of these mortgages start maturing. I have very wealthy clients who own a lot of real estate who are starting to be impacted. Folks who are a lot more affluent tend to have more reserves, more money, more income, but also are a lot more business oriented. And, you know, we have one client in Ontario who's kind of approaching it in an interesting way. And he called me the other day and we were chatting about this and said, I have a building that's a conventional loan. He doesn't really want to play the CMHC game on that one. And he said, I'm going to go from 3% to 6%. that'll probably put me into small negative cash flow. But I bought it for 4 and now it's worth 6. So I could sell it, pay all the fees, pay all the taxes, and get $1 million in my jeans. I think I might do that instead. So it's good, the level of inflation and the actions of the Bank of Canada are going to have a lot of unintended consequences. And I think for a lot of the people who have a lot of the money that's driving inflation, particularly when it comes to things like personal services and consumable goods and durable goods, it's not having the impact that we think it is, and it's having a greater impact on people who are less able to afford it. Soapbox done. Talk about the type of inflation that I like to see, and I like it from 2 reasons. This is from rentals.ca, which it's based on new listings, so take it with a grain of salt. And there are no really good resources for rents actually are. CMHC is not bad. Rentals.ca is not bad. As a human who has to live in Alberta, I like the fact that we are on the profoundly affordable side of this equation. As a landlord, I like the fact that when you go to Edmonton 1 bedrooms, we are up 11.5%, and 2 bedrooms are up 14.5%. That lines up with the rents in my building and with a lot of other ones. We're doing a deal in Red Deer right now where all the one, like when your property manager emails you and says, we have a notice, but the rents have gone up $300, $400. We think you should do a little reno to capitalize on that. You've moved into a fun place. Most property managers are not well incentivized to try and get you to bump your rents. Pretty much every market that we are working in right now, and we work in a lot of small markets, are seeing significant increases. In the larger cities, in some places, you're seeing, I would say, less rent growth than expected because, Edmonton and Calgary in particular have figured out new construction in a significant way, and there are thousands of units coming to market. However, we've also heard stories of those premium buildings, seeing $1,000 a unit rent increases in Calgary. There are some really banana rents out there, and for small units too. I didn't pull a lot of numbers about vacancy because the story on vacancy is just low pretty much everywhere. Where in Edmonton, we're talking 3% now. What did they say CMHC is going to next year? They're forecasting 1.8.
That sounds right.
Yeah. It's one of the, someone else asked a question in the sign-up sheet. They were like, what about your pro forma numbers versus lenders' pro forma numbers versus what we're actually going to see in the real world? You get a bowl full of chicken entrails. Nobody knows. It's all kind of crap. CMHC is going to continue to use low numbers to justify injecting a lot of money into the system. CMHC falls into that category of too big to fail, which is kind of interesting on its own. I think that what's going to continue to happen is that when it comes to the pro formas that we generate, we're focused on giving people the right balance. At the end of the day, rents and vacancy are a choice. If you want to rent it for $600, you're always full. If you want to go to $1,800, you're going to endure a lot of vacancies. So the right balance is a property that will stay reasonably full and get you close to market while not incurring a lot of vacancy. So sometimes we'll go for a low vacancy, but we'll have real conservative rents in our pro forma. The thing I've come to appreciate most about every property in a non-rent controlled environment like Alberta, turnover is your killer. If you can keep people in there longer, you're going to do way better. Bumping someone out over a $200 rent increase is probably going to trigger a $10,000 or $20,000 refresh on the suite. It's just not worth the delta. You're a lot better to, it's one of the things I think that is super important in the small and mid-sized Alberta markets, like both buildings and locations. When you can have superior management, you will absolutely outperform everyone else in the long run when you're looking back at your financial statements. It's all going to look the same on a pro forma. You'll just perform better. Theoretically, all the Formula One cars are the same. Some teams do better. I look at this table every single morning when they send it to me. This is from CMLS. I think you look at the same thing too every morning, right, Luke?
I do.
Yeah. So we're
Always amused.
always entertained at the capricious way that rates seem to change. Sometimes it makes sense, sometimes it doesn't. I don't feel like anybody really understands the bond market in a way that's intelligible without a master's in economics. For the moment, the takeaway on this one, aside from the 10-year bond is now like severely inverted and has been for a while. This is where if you're doing an MLI Select or CMHC mortgage, this is where your rates are going to be based off of. The thing I wanted to point out on some of this is that the spread between the mortgage bond and your rate used to be kind of like, 60 to 80 basis points back in when I funded my last one in 2020. The spread today is probably more like 90 to 120 basis points above that. So you're into a mortgage rate which is in the low fives. A lot of lenders have gotten really snotty about deal size. So if you're borrowing under $3 million, you are just going to have fewer lenders go after it. So even when we're talking about our new infill projects, we're trying to do 2 or 3 or 4 in a single application, simply to bulk up the overall loan value, even if they're securing against multiple projects. The bigger you can get, the better that yield is going to be. There is a lot of money chasing that market. The one other thing that's been interesting is that in theory, you don't have to sell these mortgages into the mortgage bond pool. There is at least some ability or interest into rolling them into the government bond pool. And that spread is not huge. It's 20 to 45 basis points, but there are a lot of things happening in the background that, every lender, even the local like ATB and Service Credit Union, Horizon, guys like that used to never, ever do CMHC. They didn't want to jump through the hoops. They wanted conventional business. They wanted to keep it chill. The past 24 months, they've done 0. Like we did one conventional loan in Vegreville with RBC.
Yep.
And I still don't know why. Like it made no sense to me. The CMHC math is better. And so those lenders are finally coming to the table and starting to learn the system. It is like teaching a donkey to walk upstairs, man. There's a joke about asses in there, we're gonna leave, but it's very difficult. However, if they're on side, they're really great, especially for construction.
Worth pointing out when we talk about rates and that CMHC versus conventional, the one thing that used to be true that we're finding is no longer true in the last couple of quarters is that spread between a CMHC loan and a conventional loan used to be, close to 100 basis points. And that's really shrunk down to what, 25, 30 basis points, maybe?
Mm-hmm. Yeah. Like you look at bank, well, yeah, you end up with a CMHC loan that's going to end up in the fives, and, bank prime is 7.2 right now for RBC. But on some of these loans, on term loans for certain borrowers, they'll do prime -1. So you're under or around 100 basis point spread. The thing that's happened that really just blows it all apart is the 50-year amortizations, which is its own level of concern. It is something that with lots of lenders and mortgage brokers, we end up talking about a lot. Take the 50-year AMs with caution. If you take a 10-year, right? Take the longer term. On renewal with commercial loans, if your net income does not go up, if it stays flat and the rate goes up, you're underwater and the bank is going to come looking for a payout. And we're seeing tons of that on buildings that were, done in, 2019, 2021. And they're seeing cash in refund. We saw a lot of it back then from when it was low in 2015. Now, CMHC's MLI Select has saved a lot of people's bacon because you're able to refinance it out with the new program, but it is going to be a long-term risk. When you've done an MLI on day one and you can't move your income, there's a risk there. It's a wonderful tool, but it is a very sharp knife to play with. CMLS also added this wonderful chart. I've always loved all the different versions of financing they can give you. I like the fact they have now an interactive chart to play. And the one thing that really shows up on this one is just how much of a space there is between the 10-year and the 5-year. It very seldom inverts quite that hardcore. Usually pretty close. Sometimes the 10-year is more expensive than the 5, the way it's supposed to be. And it's backwards right now and will continue to be so. We'll talk a little bit about recessionary risks, but I'm not unduly concerned there for the moment. This is the chart our friend Jay Hubbard gave us. All of the banks are consistently wrong, right? Everybody's wrong all the time. This is the part that's entertaining. So Bank of Canada's overnight rate, the benchmark rate, no one expects it to come down until the middle of 2024. There are some interesting reasons why it could or should come down sooner, among which the government has printed an enormous amount of money and carries a lot of debt as a impact of quantitative easing and all the rest of it. And the cost of servicing that debt has now gone through the roof, particularly in the US, but also here, which makes me really miss Ralph Klein's willingness to pay off debt and have net assets. But governments don't seem to do that anymore. When it comes to the Government of Canada bonds on the 5 and the 10, there's got to be a better way to try and share this info. I think Jay did a wonderful job with this chart. But if you were starting a project now, planning for completion in 2024, there's a lot of good reasons why starting either a value add project or a new construction project now, planning for today's bond and using that as your benchmark to plan for some lower in the future. There's some reasonable data from some smart people to say that that is a reasonable way to plan for that risk. When rates were 2%, none of us planned on 5%. So if we're wrong, we will all be wrong together. But I like at least starting with smart numbers from smart people who are almost always wrong anyways. Luke, do you want to chat about the CMHC changes with the approvals and the new fees? I didn't even put a bullet point for the new fees because I feel like I've talked to death about that with clients.
You probably have. So we saw fees on the CMHC MLI Select program go up in June, and they hit, I think it was the middle of June 16th, if I'm not mistaken. And they basically doubled them, but just brought them in line with the old CMHC Flex program. So that was the first time I'd seen a new government program with lower fees, and apparently they figured out that they'd never done that before and didn't like what the precedent they were setting. So fees are back up to where they were before. But in the run up to that, as we heard the news, I think it came about April, we heard that was going to happen. And the applications started to increase crazily. I was trying to come up with a really good word there, but I didn't have one. So crazy is what you get. They went from an average of something like 300 applications in the queue at any given time to well over 3,000 last number we heard. So what I was telling people a few weeks ago was that if you get your application in today, you might get a very nice Christmas present and get your mortgage approved before Christmas. But generally speaking, mortgages wouldn't be funding until the new year. And now we're definitely looking at middle of Q1 probably for approvals should your application go in today.
I think that part of that too is them just trying to lower expectations so people don't get annoyed. CMHC did hire a huge number of people about a year and a half ago, kind of in anticipation of this. And because before that, even with the old program, rates were so low, they had a lot of apps. But I think they are figuring out who's really great at their job and who needs to move along, not that they'll fire people. They have made a couple of changes that are particularly impactful when it comes to new construction. So the operating expenses, I won't include the chart. I can send it out if you want. They've raised some of the expenses, particularly as it pertains to management / caretakers, and then appliance repair budgets and things like that. Doesn't make a huge difference here, but it is a little if you have a project that's tough to pencil. The other thing they did is that there were lots of people who would submit an app and just get it approved and get started. And then as rents increased, I mean, first off, they wouldn't let you in. They did three things. They wouldn't let you increase the rents from your initial submission. Like you'd put your app in based on $1,500 a month. And then when you got closer to construction, if it was, or completion, if it was 1,800, you just update it with an appraisal and they give you the extra money. Or vice versa. You do the same thing again but with vacancy, just as the market improves. That happened in Edmonton a lot. Or if you had construction overruns, you'd get a new appraisal and then you'd be able to finance your extra cost that way. What they have done now is, oh yes, on MLS Select, they have a rent increase, like under the affordability stream, a rent increase limit based on the consumer price index. If you put your rents in at $1,500 when you apply for construction, when you're done, those rents are tied to the number you used at construction and they have to be defendable. So you don't get to bump it up during construction. All this is a way of saying that if you have a project where you've applied, you've got your certificate of insurance and you're doing all your construction, and then you decide, oh, my numbers have changed, I want to increase, improve, or substantially change my loan, you have to resubmit for a new loan. To be allowed to resubmit, you have to cancel your old COI and throw your mortgage in the garbage. So they've essentially made it pretty difficult to make that process go round in circles. That was a long-winded explanation that was not my intention. I said I wasn't going to go through a ton of details about where the market is and what's going on, but part of that is because in Alberta, the rents move so quickly. What does a cap rate really mean? Like the building that we'll talk about in a minute in Drayton Valley, they moved those rents from 700 to 850, and I think they can go to 1,100 in 91 days. So whose cap rate do we use? For the moment, we're using the same appraiser with the same math, so we're getting something consistent. There are a lot of nice buildings selling at higher prices, an average price per door of $156,000 a unit and a mid-4s cap rate. Now, this is data that only goes to the end of May. But even then, you look at where the bonds were, they were not that much different. You're talking maybe 30 basis points different. When it comes to other commercial assets, just let me say out loud, and we have a graph to kind of help go along with this because I end up explaining it frequently. When you can move your rents profoundly in 12 or 18 months, your cap rates are not coupled to your debt. If it's an industrial building and you've got a 5 or a 10 or a 15-year lease with defined renewal amounts, yes, your connection to the debt defines your yield. It's a big problem. But in Alberta's multifamily space, the connection between A and B are not that significant. This is also not a weighted per unit price or cap rate. This is just deal by deal. I mean, as you'll see, there's a $24 million deal in the middle there next to a $660,000 deal. But even the small old stuff in some of these places is selling for, you know, land value. There was a 64 unit deal in Oliver. I would say that's halfway between an economic and a land deal. There are a couple of other ones here. The willingness of people to essentially land bank. There's one deal on 124th Street that made no sense at all to me, and a couple deals in Strathcona here. At 160 a door, it did not make sense. But that is where, you know, we're seeing those types of land banking deals again, and people are waiting for the new zoning bylaw. We will do a separate podcast video on the new Edmonton zoning bylaw because it is really going to change a lot of things about infill. Luke made me this wonderful graph this morning because I got sick of drawing it out for clients by hand. Particularly people from Ontario and BC. We love you all. We need to explain something which is not, I think, as complicated. People frequently on day one will say to me, well, if my debt's going to be 5.5%, I can't buy a property that's only a 4 cap. Yes, you can. Because when you do that, when your cap rate is below your interest rate, it's negative leverage. Every dollar you borrow reduces your return on investment. It takes more cash to make it fly. Will they still finance? Yes, especially if you're using interim to get to a takeout product. But this is the thing, you have to think about it in the context of your full investment horizon. This area is no fun, right? This is negative leverage. But much like the deal we'll talk about in Drayton Valley, or a lot of the things that we've sold lately, where there's even a middle of the road building where you're not spending money on repairs, you're just stabilizing management. How long does it take you to get above this line? That's the only thing I care about, and how well you're doing kind of in that year 3 range. It's okay to buy a building where today's cap rate, today's rent roll creates a net income that's below your debt. The real question is how quickly can you turn it around? And sometimes this window from A to B is literally 4 months. Sometimes less if you raise rents during your conditional or unconditional periods. If you need to do a bigger reno, then you're going to get to a much better place with a lower rate, and you're going to be able to pull out some equity. But in the long run, the place in between these two curves is where you have fun. I'm going to have to make a TikTok or something of that, because I get it all the time from people. Did it work with Luke? Did I miss anything?
I don't think so.
For my normal rant? Okay. If I say things that you guys like or don't like or disagree with, feel free to drop it in the chat, and Luke will poke me about it. I don't see them right now, but we are going to walk through a couple of places that we thought make sense. Like, we went through our deals and some third-party deals. There are a couple of things that work really well. I'll let Luke talk about this one because this is really his deal. He handled end to end, but we love small markets basically within the map, within the 30 to 90 minute drive of Edmonton.
Yeah, we've seen like the returns in secondary markets can just be spectacular. If people are really, really searching for cash flow, we'll often try and push them outside of Edmonton proper. This one in particular, little 9-plex in Redwater, you can see on the screen there, renovated post-fire. And so we had some clients come in and buy it for $91 a door. And part of the reason this one really made sense for them, particularly, it was a first investment for them. Both very handy fellows. We were looking at the stairs outside and they're loose, and it wasn't like, I wonder how much it will cost to fix that. It was, I think I have the 2x4s in my yard to fix that. So for them, it made a lot of sense. It was within 20 minutes of both of their houses. Their wives were on board to manage. So it was a great little investment that for them was a stepping stone. They wanted to learn about tenant management. They wanted to learn about running the project. And at the end of the day, we bought this thing at an 8 cap because we were willing to go, to that 8 cap in we were willing to pay that 8 cap, which they probably could have pushed harder had they gone faster, but they asked for time and got it. And we were able to get a fairly great deal done on what is a really nice building.
And that was a great example of a building where, because it was a smaller loan amount and a smaller center, they had very few lender options. Like, I think the spread over the bond was more like 1.5 or something. It was not they got the full loan, but the rate was a lot higher than we had initially expected. It still makes sense because you're buying it in 8 cap. You're starting with some space in that curve, right?
Definitely.
Yeah. Yep. This deal just blows me away. And a really nice, really reasonable guy bought it, who has a connection. So this is Drayton Valley. Drayton Valley is pure oil town, man. It is 3/4 tons and truck nuts everywhere, and a lot of really nice people. This is a family. I don't know if they built this one or they just bought it in like pretty much from new. They have owned it forever. They run it very simply and very quietly with a very nice lady who's probably lived in Drayton Valley since the 90s. This is one where they moved the rents up, like back in whatever, 18 months ago or 2019 when oil was awful. This building had 40% vacancy. And now it's full. Maybe you get one frictional turnover a month. Guy paid 80 a door, was very reasonable about it. The cap rate, this is a perfect example of the cap rate thing. Cap rate going in today, based on the rent roll in May, was a 6 cap. But that's based on the rents on, I think, on a 1-bedroom being like 775 to 800 and a 2-bedroom being essentially 900. But when I called 4 different managers in Drayton Valley, they were all like, 1 bed should be 1,000 to 1,100 and the 2 beds should be like 1,250. That's a, I don't have to do the math and figure out my cap rate to know that that's a hell of a lift.
Yeah, 1 quarter in a market like this can make a ton of difference.
Totally. And he, in my opinion, there's lots of people who look at that and say, well, I could just refinance and pull all my equity out. This guy did not. He went CMHC on day one. He got the loan he needed to do the work he needed, and he's just going to keep it there. And any of that rental upside and the equity he creates, he's just going to take out his cash flow. He's not going to refinance, because whenever you deal with these secondary markets that are cyclical, keep the debt low, keep your debt service low, because when things inevitably turn for a little while, that will, the equity will save you. So this is stuff that I'm messing with personally, and for a lot of clients, and lots of people are doing these. So this is a West Edmonton. This is very representative of the type of projects that I'm working on. Very chill little West End lot. It's actually, it's funny to me because you can't actually see the house. This is the house back here. Oh, back it up. Why is it like that now? Okay, I can't draw. There we go. So the lot literally just goes like that. It's a 50 by 150. There's a little house on it that we're going to tear down at the end of August. And we're going to drop a brand new triplex on it with 3 basement suites and 2 garage suites behind it. We're going to get 8 units on the lot. They're kind of silly in design. We're actually aiming to, the number one thing I care about, again, like I said earlier with pro formas, how do I have the longest tenant stay? We actually just tweaked it to make the project a little bit fatter and a little bit shallower, and to increase the size of the garage suites. Including land, your total all-in cost is just under $2 million bucks. 5% down, in this case, quite literally, this is from my actual pro forma, 106,000 bucks. And when you only put 100 grand down on a $2 million apartment building, your return on investment goes a little bananas.
It's worth commenting, if I may, Chris.
Yeah.
We just talked about over leveraging, and now we're talking about 95% leverage.
Yeah.
But we'll point out that, generally speaking, before we were talking about loan to value, here they're building with the CMHC mortgage, so they're building with loan to cost. So you're 95% loan to cost, and so these buildings are generally appraising for.
This one came back at 2.2.
Yeah, so you're not quite as offside as it would seem, at least not 95% leverage on the building. Just wanted to point that out.
Precisely, yeah. And so like we're on this particular project, I'm the development manager, right? It's not my deal. We're doing it for a client, but the barrier to entry for me to do this for a client, you have to buy the land cash. Because I want to make sure that I'm not doing this for someone where we're using their last $100,000. And if things went sideways, they would be completely bankrupt. These projects work great, but you do need the horsepower to really do the deal and have significant reserves. And that way you buy the land cash, and a year from now, when you get your first draw, you get a bunch of your money back. So we have a whole bunch of these things going on, and the new zoning bylaw that hits next year will make this even crazier. The stuff I'm seeing in Calgary is actually really crazy too. A lot of these are dedicated rental projects, The ones in Calgary are frequently going condo, which I still don't totally get. So we're doing a lot of that. That continues to work well. There are a lot of people around who are just buying nicer product. Lots of people call us and they're like, no, I want to pay just under 100 a door. And I was like, that's kind of a stupid idea. I would like to buy a car for less than $5,000 also, but I think that's also a bad idea. If you pay more, you get more. Belmead Apartments, I actually grew up like 4 blocks from this building. The guy who bought it, you know, he for a value add project, he paid almost $130 a door on day one. It's going to work out, and it's a mid-5 cap on day one. This was a great deal. Like it's going to work out really well. They'd actually done a bunch of things that don't get you more rent, like the parking lot and some other things. These are great deals. This is why you actually, when you go through the comps, there are a lot of people out there paying 130, 150, 180 per door for old 70s product. When they're bigger, they're more efficient, they're more spacious, they have better suite mixes, and you're starting at a higher place, but you can go a lot farther with it. So things that we think are going to fly, I think that the secondary market thing, they're challenging to manage, but if you already live in Alberta and are in a secondary market or don't mind driving to one and can self-manage, that goes along with the fifth bullet point, pardon me, better management where you can handle people like human beings and actually follow up with them, you'll do way better. But the secondary and tertiary markets are great. Even today, if you can grab some existing financing, especially, I mean, I have a building with a 10-year mortgage on it that goes to 2030. You better believe that thing's available for someone that wants to assume it. That can work really well. The seller financing bit has gotten complicated because everybody at the end of the day wants to go to CMHC. CMHC hates little vendor takebacks. In some cases, they won't fund them. In some cases, they will treat them as a refi and they will give you that money back, but then make you put that much more back into real estate. They treat it as an equity takeout and not as the repayment of a loan. That's actually related to another creative financing thing. For people who are doing big value add projects, CMHC is starting to make a lot of noise about essentially if you do your interim financing with a non-CMHC lender and then you go to CMHC, they are treating it as an equity takeout, which means it comes with reinvestment rules, right? I can't remember the right acronym, Sean might know. But it's coming with a lot more strings. So the number of lenders who are able to do interim financing is starting to get smaller and more complicated. So when you're doing, like, whether it's construction or value add, anytime you're on a short and definite timeline, you have to be aware that if the rules change, you're going to have to be ready to pivot. And sometimes you just don't know where it's going to go. We keep seeing really good value add. I mean, at the end of the day, most of our inventory is built in the 70s or before, and it's all going to need reno. And there are significant, it's still cheaper to take an old box and renovate it to make it look most of the way like a new box and charge 70% as much rent. You get a deal, your tenants get a deal for a new looking old car. New construction is interesting and probably worth its own totally separate webinar. And better management. Property management still sucks. There's no way around it. Conventional property management sucks. Being able to bring it in-house or manage things that are close to you, it's a pain, but you will be much more profitable. Okay, we'll go into some of this stuff a little bit in questions once I stop the video. AI tools are changing everything that Luke and I do. I spend a lot of time with my coach working on those things. And I love 90% of the tools, and I am 10% convinced that it's going to go like Terminator 2 and kill us all. The new zoning bylaw, I like 80% of it. I think it is going to pass in October and come into force at the start of 2024. and it's going to change a lot of things for new development, for land acquisition, which is its own investment category too, but also about redeveloping or developing new product. Edmonton, Alberta is kind of leading the way in North America for these types of things. And then we want to do a deeper dive into creative financing tools. We've had a couple people lately who come to us and have it's like they took a course with someone and they're like, this is the one tool I'm going to use to buy real estate. Make your deal fit into this box.
Deals don't always fit into that box, Chris.
Deals frequently don't fit in that box, especially because we spent 6 months working with the seller before we even listed it to ask all the questions about their financing and their taxes and how they account for things and their appetite for carrying things, and do they need the money? Sometimes I think people need to learn to trust that we've asked all the questions, and we've had deals that complete in a way that we didn't expect, but we absolutely opened the box and asked all the questions ahead of time. So I think we need to go through that and explore some of the other ideas with people. So we're gonna switch and open it for questions for a little bit. I am gonna stop the recording